Hi, it's John Kelly. In this module, we are going to discuss how to do efficient and effective review engagements. And as always, we want to be efficient and effective. That's the particular topic of this module. Follow professional standards and document what we have done properly. Now, I've always worried that there was some danger with the new standards because review standards mirror the audit standards. And there is a risk that some people will interpret this to mean that the review work level is the same as the audit work level. And the reason I put this together is I had a colleague phone me and said he'd attended a course and he had been told that in a review you needed to assess risk of material misstatement by assertion, documented, just like in an audit. And he said to me, I don't think that's true, and I agreed with him. And he had done the right thing because he said, I went and read the standard and it clearly does not say that. So that's what we're going to discuss. These are some of the misinterpretations that I have seen. And clearly in the standard, a review is not the same as an audit, and it is a lower level of assurance. And my advice to my colleague and to everyone is that you base what you do on the standard, not what you have heard, not something you read in a course or heard in a course. You have to read and understand the standard, and indeed the standard itself says that. So the steps for an efficient and effective review, my thoughts. First thing you do is the bookkeeping, and sometimes less frequently now we do it all. Other times we're doing what I call the topside entries. We record depreciation, for instance. And then you do the review, you assemble the file and do the procedures. And finally, you make sure that you've documented what you have done and what you should have done. And a checklist here is useful because it may remind you that there are some procedures that you just forgot, you missed. Now, bookkeeping first. When we're doing it all, I guess we should think briefly at least about independence. Should someone else do the bookkeeping? Though there's two sides to that. If a bookkeeper does the bookkeeping, they're perhaps more liable to make a mistake than if the partner, who's very familiar with the client, does the bookkeeping. So you need to think about that as well. Topside entries, and I would say in most reviews, almost always, we're doing depreciation, bonuses, taxes. Maybe we record payables because the client doesn't do that and gives us a list of unpaid invoices and we figure out how to record payables. The other thing, I think, if we assess if material misstatement is likely before the bookkeeping is done in a review or in an audit, that will lead to lots of unnecessary documentation and work. So get the bookkeeping done first, or at least notionally done first. And then doing the work, assembling the file, doing the procedures, these kind of go hand in hand. You really can't separate them. If you're experienced in doing reviews, you will be doing the procedures as you assemble the file. You'll be taking a look at the list of outstanding checks. You'll be agreeing the bank rec to the bank statement if that's what you want to do. And that's all part of assembling the file and goes sort of hand in hand. And documentation finally. Now, most of the changes in the new review section are to require more documentation. So documentation is extremely important, and a checklist can help. Hopefully a lot of the documentation will flow from what you do in the file. So as you're looking at accounts receivable, you'll be looking at the aging, comparing it to last year, and noting whether it's different or not. There is certainly a longer list of required procedures. Things that were before just best practice are now required. So we got to make sure that we document that we've done them. There are a few new procedures. Things that were just best practice before have been added, but they're really not new. But now we have to make sure we document them. So make sure you document. Now, I think I've described it as 3 separate steps, but practically it's all going to be done at once. I think it notionally helps you to separate, so bookkeeping first, followed by doing is material misstatement likely after doing the bookkeeping rather than before. The documentation phase, I find it reminds you of missed steps, it reminds you of missed documentation, and it's a final check. So all three things really happen at once, but at the end, as you complete a checklist, for instance, you will find the things that you haven't done. So a checklist can remind you of missed procedures. There are a lot more. You may forget a couple, so it's a good idea to have a checklist. And it can help you with or remind you to document. Now, for instance, and this is actually the only new required procedure, you are to consider if the records are good enough to support analytical procedures. So if your checklist says, I considered it and they were good enough, and you initial and date that, you've got sufficient documentation. If your checklist says, remember to do analytical procedures, they're really important, and you initial and date that and say, yeah, I did that, that's clearly unsatisfactory. You're going to need to have some additional documentation of the analytical procedures you did. And analytical procedures, even in an audit or in a review, are very, very powerful procedures. So make sure you do them, and doing them will produce documentation. So if you have no documentation of the analytical procedures you've done in your review engagement file, you're deficient and you probably missed something. Forget that your documentation's poor. You've probably missed something. So make sure to do that, and of necessity, additional documentation will be produced. Now, the other question I've seen is, does the size of a client affect the cost? And I think the answer to that is probably no. The first problem is, as size goes down, so does materiality. So if you have a very small review client with $1,000 prepaid that shouldn't be there, that's material in a smaller client, but not in a larger client. And having unadjusted errors or being required to make journal entries increase the cost and takes more time. The other thing I think is, if you had two clients that are of a different size, but they had the same number and type of accounts, that will take the same time to review. If they're identical in all respects, just add a 0 to every number. They're going to take the same time to review. The financial statements will take the same time to draft. So size doesn't affect it. Complexity might, but size probably not, or only a very small effect. And is a small review done differently from a large review? And the standards are the same regardless of size. It doesn't say anywhere, oh, you don't have to do this if the client is smaller than this. And as I said before, small clients with lots of accounts and lots of complexity, that's going to be more work than a larger, simple client. So size alone, I don't think, has much of an effect. The size effect on drafting the financial statements, the rep letter, and the engagement letter, same amount of time regardless of time or regardless of size. New engagement letter, just remember that the first one in the new format dated before the engagement begins. And the rep letter, use the new letter. The date on the rep letter and the date on the review engagement report should be the same. Now, the variety of work influences cost. And I've occasionally done a pure review where the client delivers a complete file, drafts the financial statements. That's happened once or twice. The typical review is the client records all the receipts and disbursements and keeps track of accounts receivable, because they have to keep track of accounts receivable to run their business. We assemble the file and do the topside entries. I would say that's the classic review. With computerized accounting packages, situations where we do all the bookkeeping and do a review engagement, that's becoming less frequent, I think. The other hint for saving time and cost, correct all the errors. It's just cheaper and simpler for us. It's the simplest, it's the most efficient. The other thing I find with a review engagement client, they would kind of be stunned to find if you're not correcting everything. Their perception is that they're giving you their records and they expect you to go through it and fix everything you find. If you correct all errors, then you don't need to report them to the client. You don't need to argue about it, that they have to be made. You don't have to conclude that they're not material. You don't have to put it in the rep letter. That's a uniquely Canadian requirement, but that takes time. And anyway, if you correct all the errors, the financial statements are more accurate. So it's cheaper for us and more accurate. So if you want to be efficient and effective, correct all errors. Then the other question is it better to do the work at the client or not? And I don't think there's a recipe. Maybe yes, maybe no. I guess the first criteria is, can they put everything in a box? One of the reasons for a big audit that you have to go to the client's premises is the records are enormous and you couldn't possibly have them delivered to your office. Second criteria, does the client have the space? Many of my clients would not have the space for me to sit and do a review in their office. They just don't have that big of an office. Second question is, third question, does the client want the constant interruption of questions, or would they like you to go away, do the review, and then give them a single list of questions at the end, which they will go through all at once? The other thing, I think the perception is that it's going to be the partner going out and doing the review, and we'll meet the owner of the client, and that's a good opportunity for partner-client contact. If it's an assistant working away at the file, and the only person at the client is going to be the bookkeeper, then there's really no advantage to that. If the owner's not there, and most of my clients, the owner-manager is a very busy person and would probably not be around for the entire time of the review. So going to the client or not, no recipe. Sometimes I think it can be valuable, but I think you need to consider the factors on this slide and decide whether it's a good idea or not. Now, here are a list of things where I've seen people go overboard. And this is the one I mentioned first. It's required in a review to assess if material misstatement is likely by assertion as in an audit. Now, you would meet what the standard requires if you did that, but that is far more than is required. And so read paragraph 46. That's the Canadian reference. I've got another module where I compare the Canadian and international references. What you could do, and this would be much more efficient and would probably be the normal case, conclude based on the inquiry and analytical procedures you did that there were no errors where material misstatement was likely. And that's the question I asked my colleague who phoned me. And he said, oh yeah, gee, hardly ever does that occur. So most of the time, a simple comment, I've done these procedures, which I documented, inquiry and analysis, and I concluded there were no areas where material misstatement was likely. That would meet the standard, the requirement of the standard as well, and be far quicker than doing the assessment like we do in an audit by assertion. And as an aside, the dictionary definition of likely. Likely means might well happen or be true or probable, and the dictionary definition of probable is likely, so that's circular. Now in an audit, risk of material misstatement being moderate is 50%, and that's more likely than not. Risk of material misstatement, some people think if it's high, that means there's a 60% chance. In my view, I don't know, there's no support or discussion of this in the standard, but I would say that likely is 60% or more. It's certainly more than 50%. If they had meant more likely than not, they would have said that. Instead of saying more likely than not, they said likely. So I'm interpreting that as high. Even in an audit, risk of material misstatement is not often high. And in a review, as my colleague and I agreed, hardly ever see that. So how big a deal is material misstatement being likely? Now, we've always had to follow up if something seemed wrong. That was always in the standard. It wasn't terribly well explained. As I said, it rarely happens now. So in the new standard, where it's now much clearer and you have to document that you did it, It will also occur rarely, but it's more closely defined, needs to be documented. Documentation, as I said before, is the most important thing in this new standard, sort of. So make sure you document it. The other overboard thing I've seen is people say, well, for every review client, you should write a management letter. And you could. That would certainly be a lot of work. That's not what is required by the standard. The standard requires those things that in the auditor, or sorry, I made the same mistake, in the reviewer's professional judgment were significant. And often there are none. So you would just note there were no significant matters that I told the client about. And you could tell the client, and I put that in quotes, I'll come back to that in a sec, verbally of the significant matters, and then document that discussion and the nature of matters in the file if there were any. And indeed, you would be foolish not to report to the client. If you found some big problem that could affect them and you don't tell the client, when it turns out to be a big problem and you go, oh yeah, I've known about that for a couple of years, the client will be very angry. The other reason I put client in quotes is got to make sure we know who the client is. Often it's an owner-manager, so it's a single person, we know who they are. But could be a board of directors, could be those charged with governance, could be all kinds of people. So if you're in the situation of a very large client with a complicated management structure, well, maybe you do have to write a management letter and mail it to the board of directors. Don't know. But often it's not going to be necessary to write a formal management letter to a client. One of the other things I saw was make a list of all material items in the financial statements and disclosure. You could do that. And also seen it suggests that you make a list of all items where material misstatement is likely. Now, what paragraph 46 says, do inquiry and analytical procedures on all material items in the financial statements and disclosure. So for instance, you could document that you compared this year's balance sheet, income statement, and disclosure to last year and inquired and document what you found. If you do everything, you will have done the material ones. And I think that's easier than sitting down and making a list and not looking at the ones that are mathematically not material. Also, there could be no areas where material misstatement is likely, and hence no work needed. So making a list of everywhere that material misstatement is likely can be simply replaced by saying there are no areas where material misstatement is likely, and that meets the requirement of the standard. The other thing I've seen people do is sprinkle materiality throughout the file. So in the cash section, they write down materiality. And in the receivable section, they write down materiality. Now, if you have to change materiality, which you might have to, I suppose, that's not often going to happen, but it just means there's lots of places to go fix. The other thing people then say is, well, only look at balances that are bigger than materiality. Well, the problem with that is if there's an immaterial cash balance, well, it's smaller than materiality, but cash could clearly be materially misstated because it could be maybe much larger, maybe it's supposed to be negative because the bank's overdrawn. So there could be a material misstatement hiding in an immaterial balance, and only looking at the ones bigger than materiality, you're going to miss that. That's why look at them all, and that satisfies 46A, which says look at the ones that are material. And that would also just be quicker and more efficient. Seen people require a planning discussion in a memo, like in an audit, team planning notes, and document this in a brief memo. Not required in the standard. There's no requirement for a planning memo, though I will allow that if you develop a checklist from the standard, there are an awful lot of items that could be pushed up to the front and called in the planning section, same as in an audit. For instance, in both an audit and a review, you should know what kind of business the client is in. And I would argue that that's planning. So having a checklist that's organized with that stuff at the top will result in planning documentation, but you don't need to write a planning memo, and you don't need to have a planning discussion with your staff and document that. The other thing I've seen, list all users. Well, it's nowhere in the standards. And be very careful. If you list a banker as a user, then you have accepted an obligation to them to make sure that they are going to get correct statements for their particular use. And unless you know what that particular use is, you're probably not going to meet it. If you're only dealing with foreseeable users, and there's lots of foreseeable users, GAAP or the appropriate financial reporting framework provides users with what they need. So I don't feel like providing a list of all users unless if I know that a banker is using the financial statements for a particular purpose, calculating receivable aging or something, I don't know, or working capital ratios or something like that. They want it to be at least 1-to-1. And that makes the working capital ratio more material for you, and you'd better pay attention to that, because if there's I had a situation in an audit once where $1,000 journal entry on a very large client bumped the current ratio from just slightly above 1-to-1 to slightly below 1-to-1. We had to deal with it because it was material, even though it was a very small amount. Document reasons. It's not in the standards. I've seen people say you have to develop support for your conclusion on materiality. No, you don't. Standard says document it. Standard says it's a professional judgment, but the standard does not say why. It does in an audit. You've got to perhaps document the factors you considered in an audit, but doesn't say it in a review. I've also seen document all reasons. If you've selected procedures, you've got to document why you selected those procedures. And I think why is self-evident. I asked the client if they reconcile the bank monthly, and the reason I asked them that is I wanted to know if they reconcile the bank monthly. That's overboard. It's not in the standard. If there is something that you think is important to document, a conclusion or something, well, surely document that. But you don't have to document the reason for every single thing you did. It would take a long time. And this is my favorite. I've saved it for last, really overboard. There are several different ways to document. So first, you could have a checklist to remind the person doing the engagement of the inquiry and analytical procedures that are needed, that they should be documented, and direct the person to provide more documentation as needed. I love this. This is what was suggested by CPA Canada for the documentation, and this is just for allowance for doubtful accounts. So there would be this level and kind of documentation, I don't know, for every balance and every transaction summary. Be a lot of work. But the other complaint I have about this, if you read it, it's kind of hard to read, but inquire about management procedures for ensuring the adequacy of allowance for doubtful accounts. And then we read what's done. Well, everything over 45 days is followed up. Give a listing. If there's no collection, we go to COD. Over 90 days, sent to a collection agency. Allowance of 50% is recorded. And we document who we met with and talked about things being followed up monthly. And then the same thing below, we see that 3 accounts were recovered, and accounts over 90 days are sent to a collection agency, which we knew from before. And that's a lot of interesting stuff. So my observation, that's a long essay, lots of names and dates, lots of documentation. Looks fantastic. Boy, someone is saying, hey, did you document stuff? Yeah, we did. Look at all this stuff. But it's only facts and information, and there's absolutely no conclusion or any discussion at all about whether the allowance for doubtful accounts is appropriate or whether it's materially misstated. And there's no connection between the inquiry to be done. We were supposed to find out how management makes sure AFTA is sufficient. And all we did was found out, well, we allow for 50%. That's arbitrary. And I have absolutely no idea whether or not that's sufficient. I would have assumed that you would have done some analytical procedure, compared the aging this year to last year, found that it's about the same, or found that it's a lot worse. And if it's a lot worse than last year, well, then maybe AFTA needs to be higher this year than last. The other thing, it was all done by inquiry, no analytical procedures. And analytical procedures are very powerful, particularly in trying to decide if AFTA is good enough. So I think that was just all a gigantic waste of time and didn't meet the standard. The other thing, just as a personal preference, I don't like the word ensure. Ensure means make certain that, and we don't even get to that level in an audit. So I don't think we want to use that word in either an audit or a review. In a review, maybe we might talk about plausibility. Don't know, but the standard avoids drawing individual conclusions other than an overall conclusion that nothing came to my attention. So my inclination would be to, in a review engagement, specify a standard list of procedures that we're going to do automatically. After having done that and answered the planning questions, like what kind of business are they in, are they incorporated, then we come to the overall conclusion that nothing has come to our attention. And we can issue the review engagement report, documenting it along the way. So what I would prefer is something like one of these two, perhaps. I inquired into the method of determining the allowance for doubtful accounts and determined that it was adequate if AFTA is small, or I inquired into the method and then I documented a bunch of analytical procedures where I compared, AFTA as a percentage of receivables, aging of receivables, whatever we traditionally do to find out whether or not AFTA looks right or not in a review. And so additional documentation would be required there. So in summary, read and follow the standard, of course. All but one of the changes is about documentation, so be sure you've got more documentation this year than last year. Probably not doing much differently this year than last, but more documentation. A checklist can help you, remind you to what to do, and can help you with the documentation, but it can't do it all, and don't go overboard. So thanks for listening.